Welcome back, everyone, to Stay in Your Lane. I'm your host today, John Mahle, brought to you by Triple T Transport. With me today, Joe Lombardo. Joe, say hi to the guests.
Hey, hello everybody. How you doing, John?
Good. We got Glenn Koepke on also. Glenn, give a shout out. Glenn is with Vector. Glenn's role with Vector is customer growth.
Right.
So,
how do you do, everyone?
got a different subject. We've been seeing carriers and brokers struggle to be profitable and dropping like flies. To be honest with you, every day we're reading of another company going out of business. So we want to talk about how to be sustainable from a business perspective in these markets that are declined or declining or depressed, or compression has absolutely squashed the market as a whole. Glenn, you want to start us off?
Sure. Yeah, happy to take first crack at it. But yeah, obviously the market is a trying time for many, right? I think shippers are kind of reaping the reward right now from a cost savings perspective, and then service providers, whether asset light, or broker, are just dying to survive to the next day. So, I think overall, companies have to take a serious look of what their risk exposure is. If you haven't already, it's probably too late, candidly. But you got to understand.
I agree.
Just where your cash in the bank is, what your investor scheme is. I would say all that is fairly straightforward. I think the real lens is looking at how you go to market, what your customer relationships are like, and then how stable is your service offering. Right. So one of the examples, I was talking to a brokerage company, and their revenue decreased 50% since COVID. Right. So you think of end of 2022. So they're riding high, invested a ton, new projects, new equipment, new offices, people, and all of a sudden it's like whack. Right. We're down 50%. And one of their interesting learnings from this was, hey, clearly we have to become more diversified. Just being a one-stop shop for traditional brokerage is not good enough for us right now, because we all know the market is cyclical. So yes, at some point here, probably later this year, early next year, the market's going to swing back. But how do I become more diversified in my service offering? Right. So when you think of other services that are out there, managed transportation is one way to kind of offset a little bit of the risk that brokers traditionally carry. The other is understanding, like, am I a spot player in a routing guide, or am I a contractual player? Right. And I think those that made their business off of being a spot, trying to pick up the garbage Friday, at 5 o'clock, they've been dying, right? Because they're just not needed when the first carrier can accept everything and pick it up on time and deliver on time. And so really it is a time to reflect that you've got to diversify. You cannot just be a spot provider. You've got to move into being a contractual provider in some portion of your business, and then be transparent with your customers and partners, right? Don't try and screw them over. Make sure your customers are paying you on time. That is, dire straight across the board. And so, those that stand by each other and help each other out will reap the benefit when the market swings. The shippers that take advantage of it, they're going to pay the price here in a matter of 12 to 24 months.
Couldn't say it much better myself. Joe, Glenn knocked that one out of the park, but I know you got something in there.
Well, I guess in a deflationary rate market, as the rates are going down, carrier costs are rising. Even though rates are down, but fuel, insurance, labor, equipment, maintenance, all these things are going up or have been going up. So how does a carrier or broker, how do you deal with that? And I guess you can, the first thing is you look at, how can I cut costs? People, equipment, look at my real estate, look at vehicles. So that's the first thing. That's the easiest thing to do, but that comes with with some bad side effects, especially with people.
That's short-sighted, don't you think, Joe?
It is short-sighted, but again, if you're in a critical period where your revenue is going down and you can't get any rate relief from your shippers, you may not have any other options. The next option is you got to look at improving your processes, what you're doing. Can you be more efficient? Can you do more with less? So you got to look at all your processes. I think there's a way. Can you get some cost out of the system there? Then I think Glenn mentioned this. The other thing you would have to do is maybe you seek new business. Go look at customers or segments of the market that maybe you haven't played in before. Can you get some new business? Are you able to spread your costs out over more and diverse business? The other thing is, and I know a lot of carriers have a problem with this, especially small carriers, you need to really review your current customers, your current list, your book of business. Are you making money with these customers? And I know a lot of carriers are hesitant to, what I say, fire a customer. If a guy is just costing you money and you're not getting a good return or any return, why would you continue to do business with that person? It's easy for me to say, but again, if you're a sound businessman, you should be looking at that. And I guess the last, you need to look at your technology, your TMS, your any technology that's touching the customer and your people. Is it the most robust? Is it strong enough? Do you have the latest? Can you improve there? So these are things that you could look at. But again, the easiest thing is just to go in there and start whacking people or whacking services.
I'm going to jump in here and share what I've watched happen across the industry, maybe as a 35,000 foot view of what we've seen. Post-COVID, we have seen a shift. During COVID, previous to COVID, drivers were the commodity. If you had drivers, you could buy equipment. During COVID, a lot of people still had trucks sitting because they couldn't get drivers for them. But they didn't give the equipment back in the hopes of getting a driver and then generating revenue. Post-COVID, that's a different game. The plethora of owner-operators and single guys that were really company drivers that went to be owner-operators or were owner-operators up until COVID and when we hit post-COVID, so many of those sold off the truck and trailer and went to be company drivers, which did something good. It took some of the pressure off of the driver role. But I will say, the truck driving job was the only job during COVID that has outpaced inflation, right? We start looking at what jobs, what career field could you go into that would have outpaced inflation? Well, I think that's for a couple reasons. One, they were undercompensated going into COVID. Glenn, do you agree or disagree? So you have that picture. And then post-COVID, there's no clawback on the driver's revenue. When you break it down to the trucking company, they can't lower the driver's wages. The drivers are actually having to pay for groceries and gasoline and raise their families during this market too. So the clawback was not successful in that scenario, which puts more pressure on the private companies from a financial perspective. Then to Glenn's point, contract versus spot. I'm someone, and I wish there was no such thing as a spot market. I think the spot market does nothing but break down and commoditize people as well as capacity in this industry. The trucking business is a service business. It's not a utility. It's not a gas line, phone line, cable service, streaming service. It's none of those things. It's not a software. It's a service industry. So anytime that you are investing or putting yourself in a position where you're heavy in the spot market, that pendulum will take you to the top, but also drop you off and let you fall all the way down. But I think there are some, fortunately for me, not many of my clients and of our clients have chosen to follow the pendulum spot market. We've seen a few, and they know who they are. And to your point, Glenn, karma, what goes around does come around. And you just have to sit back and let it happen. What you can do from a carrier's perspective, at the beginning of this rant I'm on, we saw, carriers trying to buy equipment, trying to increase their size, et cetera. Post-COVID, that's not the same. Guys that had 25 trucks are maybe 20, 21 trucks. Guys that had 20 trucks are 16, 17 trucks. They have thinned the herd a little bit to fend off, stay solid financially, fiscally responsible with their revenue. A couple weeks ago, we had Billy Barstow on talking about where he is and his organization, and he's down to 17 or 18 trucks, stopped buying new equipment, turned away 5 new Peterbilts, and bought multiple trucks that were under 100,000 miles on them and were within 2 years old, which I think is a smart thing to do in today's market. I got to give my shout out to Bob Costello, chief economist for the ATA. He said those that didn't overspend on equipment and aren't over leveraged in equipment can make it through this. Those that did overspend and that are too heavy on high-priced and overpriced equipment will not make it. So agree with Bob on that. But what's a broker do? What does a broker do, or a quote-unquote, I hear the new term hybrid, which is an asset-based carrier who brokers, and sometimes the majority of the freight they broker, but hide under the guise of an asset-based carrier for some level. But how does the broker block and tackle better and work the fundamentals and mitigate a large amount of costs? Glenn and Joe, that's my question for both of you. Let me hear it.
Yeah, maybe I'll take a crack at it if it's all right, Joe. But I think it's predictability is key. Automation is key. I think oftentimes you look at brokerage operations. My background was heavily in managed transportation, and we measured everything in shipments per person per day, right? On average, how many shipments fully loaded with overhead can a resource manage for truckload? How many for LTL? How many for ocean? And list kind of goes on and on. And many brokerages are operating at anywhere from 4 to 8 shipments per person per day, and that metric in itself, I think, is a key area to focus on. Right, like any point I'm touching a transaction is costing me money. And John, I think you hit it a little bit before of like, if you don't know your P&L at a customer level, you are leaving money on the table. And if you are at a point now where you are afraid to fire a customer or walk away from a customer, you are doing bad business, candidly, right? Like your shippers come back to you no different than a carrier should be able to go back. And what's a little maddening in this whole thing, for those that have been in the industry a long time, this is no different than what happened in the ocean market 10 years ago, right? It's frankly not too different than what we've seen happen in the LTL market with NEMF and a little bit with Yellow. But you take it back to the ocean market, it's a little different in the sense like ocean markets, call it 20 carriers, dominate global trade, even though there's a few hundred. But you had all these carriers racing to the bottom dollar and cutting price just to get some level of freight on their vessels.
Continue watching on the next episode of the Stay in Your Lane podcast.